I hope you guys are having a great week, great day, wherever you are and whatever day it is for you. As always, it is Friday on the podcast, and it is a nice and rainy Friday here in Seattle, which a lot of people would expect. So, feeling that February weather. It's not February, actually. We got one day until February. So, February will be next month. But yeah, it's going to be a good day because we got Patrick Grimes with us here on the show from Passive Investing Mastery. Patrick focuses on recession resilient portfolios. He invests in a lot of stuff, but specifically in real estate, he's into retail, industrial, and apartments. So it should be an interesting episode to jump into. Patrick, thanks for hopping on.
I'm glad to be here, Gabe. Looking forward to the chat. It's obviously a topic which is near and dear to my heart and my growth over time.
Nice, yeah. And before before the show, you were mentioning that you've lost everything at one point. And I actually forgot to mention that we always start the show with stories. We like to hear how people got to where they are. So I know you got a good story. Why don't you take us to the beginning of your experience in real estate and just tell us how you got here?
Well, I started out as a pretty successful real estate mogul. No, I'm kidding. So, yeah, I was a hardworking mechanical engineer, automation, robotics guy, and just trying to figure out where to diversify. I talked to the founder of the company I was working for as a machine design firm, and I had a lot of respect for him because he's like 30-year titan in the high tech space, and I said, "Hey, where should I be investing?" And I thought he was going to say stuff like high tech stocks, and here's the startups that we know about that we have an insider on which ones you should get into. Which there were a lot of those because we were doing robotics for new technologies. But he said, "No, I make my money in high tech, and I put it into other things, specifically a lot of real estate." And I said, "Wow, it's really cool." He said his only regret was not investing more sooner. So that's what got me on the path. Not that I was very efficient right off the gate, right? I got head over my skis pretty quick, trying to get rich quick and double and triple my money. And this was back before the subprime mortgage collapse. So I got into pre-development, fairly speculative, personally guaranteed on a loan. Thought I was king of the world, and I toppled pretty quick. Everything fell upside down overnight, and took me a couple years to even exit that, and then several years after that to recover financially. So yeah, that was my success story, prodigy child type, beginnings.
But it doesn't end there. I mean, since then you're very successful now, but those the personal guarantees on loans, I have heard that story before, and it's one of the pitfalls that I always like. If you don't understand how real estate works, it's one of the things that can get you very quickly. You always want to not put a personal guarantee on a loan for everybody listening out there. And so it can definitely hit you, especially if a downturn happens like in, '08. But yeah, you're not alone. It's happened to a lot of people. Unfortunately, you had to learn the lesson the hard way. But like we say on the show, all lessons, they lead to something better, which it did for you. So once you learn that lesson the hard way, you got stuck with you said it was a development deal.
Mhm,
Yeah.
mhm. Pre-development. So, it's yeah, really gamble.
Yeah. So what happened after that? So you invested in it. It sounds like you did exit that deal.
Actually, I paid for quite some time. I wasn't My note got bought and sold lots, and then I did settle through an agreement to go through foreclosure if they didn't come after me, but then they wrote off the debt as forgiveness, which meant I had to pay income tax as ordinary income for their forgiven debt. So,
I
there's no
didn't know
rest for
that.
the wicked here. It didn't really,
Interesting.
and I didn't really even understand that part. Like, I had an attorney help me even hunt down the lender, but um, nobody told me that I was going to be footing the income tax
Hmm.
for the bank's write-off. But that is a real thing still today. People don't realize that. But
I did not know that was a thing. That's interesting.
yeah,
So yeah, that is quite
taking you
the
while you're
way.
down.
Yeah, that is quite the introduction to real estate. I'm sure that put you a little bit of a sour taste in your mouth, but you're still in it. You're still in the game. Tell us how it
I
went.
was Yeah, sorry, go ahead.
Yeah, tell us how it's gone since then.
Yeah, it took me a couple years. I wasn't planning to get immediately back into real estate. I didn't even think about it. I just doubled down in my career. The whole time I was still, successful engineer. Loved engineering. Still to this day, I miss it. Right, I'm not doing it anymore, but I got a master's in engineering, and I got a master's. I got a business administration degree, and I started climbing that corporate ladder, and I switched to a smaller company where I could have a higher position and started doing some real cool stuff. I mean, I was doing satellite solar cells, and I was, doing ablation catheters in the heart, and heart valves, and missiles. And I was working in Tesla. I was doing like the rotor assembly, robotic rotor assembly for the Tesla. So I was doing really well, but then all of a sudden bonuses started coming through, and I was like, well, what am I going to do again? And so I started following the breadcrumbs of the wealthy. And the biggest allocation out of equities, stock market, really tends to begin to be real estate. But how do they do it differently? So I kind of learned about recession resilient asset classes, and buying things that exist and not speculative things that don't yet, and buying things for cash flow. Um, so I started building a single family portfolio in not California where I was at, but in Texas, where things were much more resilient. I was successful, but I was trading so much of my time away for my family, friends, and hobbies that when I met my wanted to be wife, I had to take a break. I kind of revisited it after we got married, decided to trade up to apartments where I could partner with others and reach further into different markets and scale, where we could have on-site property management and maintenance. And that leveraging others and partners was the first time I'd done that. I've been in more partnerships than I wish I had, and I've done more deals than I wish I had. But at the net, you don't win without getting out there and fighting and learning new lessons. But on the other side of it, I learned how to do it in real estate, and I learned how to do it in legal industry and the medical industry, and I've got precious metals and energy. Now, I've built a great diversified portfolio for myself and our investors, and it'll live out some of these market swings. So that's been really the progression of my investing journey and our focus today.
Nice. So it's interesting you said when you got back into real estate, you kind of took yourself out of it for a little while, and then you got your bonuses at Tesla. The satellite solar cells, by the way, that sounds really interesting. Having I don't want to go into
Hockey
it, but
just
that
full
does sound
stuff.
interesting. It is interesting that when you were getting back into it, you wanted to do recession resistant asset classes, but you mentioned single family as where you went, which is not a recession resistant asset class. And so take us back to that research that you did, and what kind of popped out as why did you start with single family? Why didn't you go into something that is, traditionally considered recession resistant?
Well, so recession resilient, is it's kind of a matter of perspective, right? And it depends on what are we talking about. Are we talking about like broader market fluctuations in the stock market? Does multifamily ride the same curve? Are they correlated, right? Or does single family or multifamily ride the same curve? Are they correlated? And they're not. They don't tend to drive on the same market fundamentals up and down together. And so you could say if a recession means the stock market, then it's non-correlated. It doesn't necessarily mean it doesn't have its own recessions, but if you look throughout the United States, and this is where I answer your question, Gabe, because different markets have a latent exposure to downturns, and they recover quickly.
Mm.
And I didn't realize that. And so I don't do a lot of work in the coastal states. I don't do a lot of work in the southeastern and Florida, or in states which have traditionally had really poor recovery, like in Phoenix and Tucson, where it took
Mm.
14 years, right? And the reason why is because if you look at other locations, the reason why I chose Houston to get back into is because if you plot the data at the Federal Reserve, you can see how the housing bust happened. And in most markets, you saw a dramatic dip down. In some, it was 14 years to recover to break even. But in places like Houston, for the 3-bedroom, 2-bath, the longest running, highest appreciating, most stable asset class in non-commercial real estate, it literally spent 4 quarters wavering slightly. 4 quarters later, it started ticking back up again. And why is that? Why did Houston outperform in residential 3-bedroom, 2-bath more so than other markets? Well, you got to look at the fundamentals behind what was going on in Houston. It has energy, it has medical, it has logistics, it has and high tech. It has all of these markets, right, that don't ride on the same market fundamentals, that aren't driven by hospitality like some of the bigger states that have cash flowing capabilities so people can keep their properties afloat, and that have landlord friendly and business friendly laws. So in downturns, they tend to have an ingress where they bring in people fleeing other places that aren't as friendly. So you gotta not just say, like you're pointing out accurately, oh, it's not recession resilient. Well, in a macro, but in a micro sense, you can actually spearfish yourself into a really secure micro type of asset within a specific region with a specific business plan, cash flowing existing, just buy it and then renovate and refi and repeat, that you can actually build and every single kind of asset class out there, whether it's doing an energy, you could be wildcat drilling and losing it all. Whether it's angel or venture investing, you could be gambling on startups and lose it all. And I saw that happen a lot while I was an engineer because I was doing robotics. And legal, you could be investing in highly speculative cases, or in medical, you could be investing in highly new technologies, or you can invest when things are stable, they're resilient, and they've gone far enough along to where you can underwrite and make a reasonable allocation at a lower risk with a lot of insulation from market volatility. So
So by recession resilient, you were more you weren't talking about asset class. You were talking about location. You when you did your original research, you were looking at locations that performed well historically in recessions versus the asset class itself. Is that
both,
accurate?
both. Yeah, it's both the asset class. So the specific, like you're asking me, why did I do single family? Well, I did single family, 3-bedroom, 2-bath in Houston because the
Mm,
combination of
good
those
math combo.
two produced one of the most resilient resilient investments in America during the subprime mortgage collapse was 3-bedroom, 2-bath in Houston,
Mm,
right?
interesting. Cool. So I mean, it sounds like you have a lot of interest in doing market research, which is one of the most important steps in deciding or in having a successful investment. And I've learned that the hard way in investing in areas that seem great, but down if you don't do enough due diligence, under the surface, things can come up to bite you. So let's talk about today's market. There's a lot of, I won't say I don't know about volatility, but there is questions about what will happen in the future, interest rates, etc. So what do you see as the opportunity being, in today's on the ground market for real estate?
Well, so single family actually did pretty well in this last high interest rate hike and eviction moratorium net compared to what we've seen in past cycles. Single family has not taken this colossal hit, right? And so it's remained relatively strong compared to other recessions that we've seen. So I don't see a huge opportunity. And of course, you got to go by specific region and market circumstance, but I don't see a huge opportunity there. I think a lot of the returns have been priced out. People are still assessing it as lower risk. What we do see is in commercial real estate, and that's why diversification, even within asset classes and outside of asset classes, is important. Commercial real estate, whether it be whether it be multifamily or an office, took a colossal hit. But commercial real estate overall dropped around the country 10, 20, 30% in valuations. And because of the scale, that's significant discounted buys. And with interest rates really, really high and banks on the sidelines because they're not getting paid off and they're having liquidity issues, you can lend high. So you can either buy low or you can lend at really high rates. And so that's why I think in commercial real estate, we set up two opportunistic funds. One which is a income fund, that lends debt to small balance commercial real estate operators, kind of the forgotten ones that are struggling to get debt. Usually they could get it at 6, 7, 8%. Now it's like 10, 11, 12%. That's incredible return for a low 60, 65% loan to value, stabilized commercial building, industrial. In fact, industrial right now has the lowest occupancy in the United States. So really incredible. And then, or you can lend on it, or you can buy at incredible discounts as well. So a lot of opportunities in those two, and that's why we are currently lending and acquiring in an income and an acquisitions fund.
On the acquisition side, what are you guys looking at? What asset class and then what locations?
Well, so we're staying away from multifamily so far, not deliberately, but we're staying away from multifamily because we have not found they don't quite pencil yet. Where there's a lot more, let me just say there's a lot more attractive investments in industrial, where even pre-COVID, we saw a bunch of reshoring. Through COVID, we saw tremendous reshoring. And now with this tariff battle happening, it's incredible, the reshoring that's happening. So the lowest occupancy vacancy across commercial real estate asset classes is currently in industrial in certain markets where you can it's like I said, it's business friendly. There's plenty of labor to facilitate. So industrial, warehousing, manufacturing, and through COVID, we saw a lot of distress in the retail shopping centers. And so small strip centers in certain demographic areas where they're not using Amazon and they're using a lot of cash still. And so those demographic areas that where you see just incredible mom and pop type owned properties that are just looking for an out. They're just kind of battered and beaten. They're tired of it. They just want to get a reasonable a reasonable exit. We've been able to step in and pick these properties up for credible buys. And so we haven't found any multifamily yet in that specific fund. We haven't found that pencils anywhere near the other asset classes, and we haven't found any office. And office, man, it's like it's a hot knife still falling. And it's just hard for me as an engineer to calculate any kind of a knowable risk to that one. I just can't seem to compute that one. So we're gonna just let that sleeping dog settle until we can figure out where the bottom is.
Wait to see what happens. Yeah.
Mhm.
Yeah, it's funny. I'm actually I'm under contract to buy my first retail property, and we got a good deal on Indian, so we're closing that right now. So it should be interesting to see how that goes.
Good for you.
On the industrial,
Congratulations.
yeah, we're excited. On the industrial side, I have a partner who that's pretty much all he does is industrial, and he absolutely loves the asset class. The thing that I've heard against, I don't buy industrial. I don't know enough about it to really be dangerous, but the argument I've heard against industrial, occupancy is really high right now, but the tariff action and all the onshoring, people are saying that is not it's not something that you can plan long term on because changes in administration, changes in policy could reverse that trend. Do you see that happening, or obviously you guys are bullish on industrial? So tell us what you see for 5 to 10 years.
Oh, so like I said, even pre-COVID, right, we saw a lot of reshoring. During COVID, we saw tremendous reshoring. There's been a fundamental shift in the way that a lot of the companies in the United States perceive offshoring. Offshore 100% of their manufacturing supply chain, but now they've realized, man, we've got to build warehousing. We've got to build service support. We got to build necessary and critical infrastructure stateside, and they've switched their calculus. So those are long term things aside from the um, the tariff battle that's happening. But in general, America, as an overall macroeconomic change, is shifting towards doing more manufacturing domestically, and that is been progression that's happening for some time. And we're realizing that we cannot rely on the cheaper countries as much as we could before, and there's a significant national security risk with continuing to offshore so much to China. And so there has been huge moves to move things domestically and into the Latin American countries, so, over the course of the last 10 years. So and you also got to keep in mind, we're opportunistic buyers. So we're not out there buying properties on the hairy edge of profitability and betting on future appreciation. We're out there buying assets, like I said, for mom and pops, those individuals that were holding that struggled, for one other reason. Or maybe it wasn't this property that they struggled with, but they had a large portfolio, maybe multifamily, maybe an office. It's just that it just really hurt them and they needed to exit, or they're retired, or they inherited it, and then now they don't know how to operate it. They've struggled. We're buying those opportunistic type. It's an opportunistic fund. So we're buying right rather than hoping and praying. I hoped and prayed for appreciation back in 2006 and 7, and that didn't work out for me.
Yeah.
So that's really the key, I think, is making sure you buy right. But
Yeah, I was gonna
macroeconomically,
say, it doesn't
yeah,
matter what your strategy is. If you get real estate at the right price, it's really hard to
right.
lose, and so that should be everyone's first priority is making sure that you buy right. Um, so I just took a peek at the clock. It looks like we have run it down, so it's time to jump into the quick question round. You ready?
Ready. Go for
Let's
it.
do it.
Surprise question round. You didn't warn me about this, so here we go.
Exactly. All right. It starts with education. It could be any form, could be a book you've read, conference you've gone to, mentorship program you've been a part of. I just need two recommendations, one for general life wisdom and then one for real estate.
Uh, Let's see. So, I on a personal note, I have seen throughout, especially with being connected to so many, real estate investors over the course of the last couple of years that just, saw their portfolios just decimated. I mean, I went through that in 2009 and 10, and I've seen a lot of people all in commercial real estate. I've seen a lot of tough, challenges and people struggling, and a lot of divorce, frankly, surrounding me. And so um, I started reading this book called Bulletproof Husband and following this group. And I got to say, I just was so impressed. I run every day. I listen to podcasts, I listen to webinars, I listen to TED Talks, and a ton of audiobooks and to self-help. And I thought, well, you know what? I'm gonna get in front of this here and I'm gonna start self-helping me as my role. And I've got a 3-year-old, I got a wife, and I want to be a better husband. And so I started maybe people are way ahead of me and they're like, "Oh, I've been reading marriage books for years," but I haven't. So I got that a really cool book, and I think that's just general wisdom and something new that I've been attacking for the last couple quarters. Recommended me by a bunch of people that I respect. And the other book for so if, because you said I could say one, I actually give this book away for free, and it's one that I collaborated with some really cool people on. It's called Lessons from Thought Leaders, and I tell my whole journey. And I've got some other people that contribute. I wrote a whole chapter. A couple other people wrote a chapter. Phil Collins, lead guitarist of Def Leppard. There's a Navy SEAL here next to me on the cover. Eastman, Tom Ziegler, Dennis Waitley, Brian Tracy. I mean, such an incredible group of people. I was just like mind blown, just excited to be involved with these guys. But I tell my whole journey from high tech to losing it all to single family, losing my time for my family, friends, and hobbies, and then getting married, trading it up to larger apartments, and then getting into energy, legal, medical. And if it helps to inspire anybody along their way, you can go to our website, Passive Investing Mastery, passiveinvestingandmastery.com/book. And if you got to put Gabe's name or you got to put the name of the podcast in there, because we don't give it to people that are randoms. So as long as you put somebody in the promo code that we recognize, put in Gabe, put in the real estate podcast, and we'll either let you download PDF or we'll send you a signed copy. It's pretty cool. And if it helps somebody along their journey that's out there, hardworking professional like I was, get kind of some aha moments about ways in which they can grow more financial security through diversifying into non-correlated alternative investments. It's enough of a thanks to me, and be happy to chat with you if you felt that way.
Awesome. Yeah, and I will put that link in the show notes. We'll talk about this at the end as well, but I will make sure to put that link down there so you guys can stay tuned for that. That was a good recommendation on Bulletproof Husband. I have not. I'm huge on all types of those kind of self help books. Marriage books are great, and Bulletproof Husband is one I have not heard. I might have to pick that one up. Next question, we're going to move on to your younger self. Let's go back to the Patrick who was still a mechanical engineer. He was just getting his first job. I can't remember what you said you were doing, but back in the day when he got that first job as a mechanical engineer, go back to him, look him in the eye, give him one piece of advice moving forward.
Yeah, well, I was pretty sure I could rule the world and I was a great engineer. I could be a great everything else at the same time. And I think what I would tell myself is learn to partner and get under, partner and and lead and join others that have been down the road that you're going down, and don't try to control everything, but join with a proven partner and take less of the deal. I would probably say that, because when I finally learned how to do that 10, 15, 20 years later is when I finally started being able to enjoy my life and build more security at the same time.
Yeah.
And
Yeah.
that's what I've.
And that sentiment has been echoed so many times. Your episode like 600 something, and so many investors who have come on here have mentioned that they wish they would have started by mentorship through some type. It could be a direct mentorship where you meet with somebody who's actually done it and they teach you how to do what you're trying to do, or it could be indirect where you invest alongside them. You take maybe you're an LP, you invest in a GP's deal and learn how they're running the deal, learn the communications that they give to their limited partners, all that kind of thing. So learning from people who have already gone down the path that you want to go down is so important. It's I mean, I wish I would have done it sooner, just like you. I started. I think I took a course and then I just went off and did it. Made so many mistakes, and I could have cut that path a little shorter had I invested in a mentorship program or something like that. All right, next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So, what is your favorite way to generate leads and find new deals?
Right now in our acquisitions fund, it is entirely direct to owner. And even in the small balance commercial real estate space, and even though oftentimes a broker does get involved after the fact, with the value so compressed in commercial real estate, brokers are out there starving. Transactions are low, and it's not the heyday. So they're bedazzling owners by telling them they can
Yeah.
sell their building at these incredible prices that
Oh
are
yeah.
so far off the market, and then locking up these properties. By the time we get involved, and it's like the broker trying to save face and beat us up while beating the owner down with his hat between, or his tail between his legs. That unfortunately, once the brokers have whispered their their promises, it's hard to come back from that. So what we've actually found is going direct to owner, and there's a bunch of different tools. There's a whole staff of people and overseas with a bunch of tools we use to find them, and there's a bunch of different methods that we're using. By having that initial conversation with the owner, figuring out where they're at, is there an urgency to exit, right? Or can they ride this out? And if there is, floating some numbers out there to just see, are we in the same ballpark? And to assess all of that before we go to brokers. And brokers are not bad, but made a lot more progress filtering out. And now, obviously, we want to close with a broker, but we made a lot more progress um, finding those deals, uncovering those rocks, finding that start with the owner and close with the broker, then finding those brokers who are putting these pretty marketing materials together, and then promising outlandish prices and fanning them out to the markets in a desperate attempt to try and get the highest offer. So that's been our take for the last 3 years.
Yeah. Yeah, I'm in the same boat. I love direct to seller, going off market, finding deals myself. Because just like you said, just brokers, the prices you guys are putting out there, I'm telling you, I don't know who's buying these deals, but there's just way too much. I don't know. I buy mobile home parks, RV parks, self storage facilities, and the cap rates that they're putting these out as for the offer
Yeah.
is just nowhere near what I would be interested in. So yeah, off market is definitely my favorite way. When you go off market, what's the medium that you guys enjoy using or have the most success with? Cold calling, mailers, texts. What's the way that you like to do it?
Combination of all of those, but my acquisition guy would kill me if I actually went into the specifics of what we're doing, because we are doing some things that we do have some AI generated tools, and we are doing some things that are wholly unique that I haven't seen done so far.
Okay, cool. All right. Next question is about the U.S. It's a big place. There is a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
I'm not about a single metro. I mean, because they all have their strengths and weaknesses, and my whole theory is on diversification across geographics and assets and industries. So, I mean, obviously, I don't like high concentrations of. I don't like Florida insurance issues. I've had, I think the Midwest did do fairly well, and the central states. I would say actually the probably especially now today, Texas is still one of the best markets. Atlanta took a huge dive. They were a great market before, but we saw the government take a turn against apartment buildings owners' ability to even collect rents. We had 18 months through the eviction moratorium from the time they stopped paying to evict in some major counties in Atlanta metro. So, uh, man, I'd say some specific locations in the Midwest and Texas are probably up there, but I'm very much a hyper focused in much smaller areas, and we build our portfolios based on a fairly broad diversification strategy. So I'd say don't get hyper focused on any particular one market because just like what we saw with Atlanta, um, where it was a long-standing landlord-friendly location that completely flipped upside down, and now there's blood and carnage all over the market because of that. Um, and Texas as well. We just saw like HSA get blown up. The tax incentives for affordable housing out there or for low-income housing get blown up, and basically, tens of thousands of units going under because of that. Because there was a political change, and they decided to just make retroactively a change to tax credits. Which, so every market has that. No matter how great it looks today, it can shift, and that's why I think it's more important to look for a well diversified portfolio.
Diversification is great. I will say on the flip side of that, it does you do get economies of scale when you do focus down in on a specific economy, a specific metro. So if you guys are out there and you're just starting your portfolio, I would suggest actually focusing in on a metro because then you can move faster. You can build your team. You understand the resources available to you in that location. And then once you start to grow, diversification makes a lot more sense. But so if you were to, somebody, let's say they're just starting out, maybe they have one or two investment properties in their portfolio already. What metro would you suggest, or even somebody who has none? What metro would you suggest they start with?
What asset class? I mean, what type of real estate asset are we talking about?
I mean, it's dealer's choice. You choose.
Um, I'd probably go for Dallas or Houston right
Mm.
now, because they have still chosen to be pretty strong. I'd stay away from. I mean, I there's some really strong. Some of our stronger assets are kind of between Dallas and Fort Worth, and between those two, there are some strong assets we have in the energy corridor in
You
Houston.
said between Dallas and Fort Worth. Those are
Yeah.
essentially the same city.
Well, yeah. Well, I mean, they are in two different places, and there's a connector, and that's what we see is strong buildup between.
Okay,
Uh,
cool. So
yeah.
you're talking like right down the center of DFW.
Mhm.
We actually we're just selling out of DFW right now. It's great, great metro.
Mhm.
But you're talking about just like that little hill area right between. That's where you guys like are trying to invest in.
Well, I'm saying if you're going to choose one that's been really strong or two that's been really strong, those two have been very strong. We're seeing occupancies 95, 97% in those two specific areas, one in that Dallas Fort Worth in between, and then in the energy corridor of Houston. And those are some of the man, it's hard. It's like we're battling off residents like right now. It's like great. It's a really strong place to be, and
Yeah, that's the place you
oftentimes
want to
it's
be.
yeah, it's the place you want to be. Right.
Absolutely. All right. Second to last question. This is about lessons learned. Not every deal we get into goes the way we expect it. In fact, pretty much every time something goes wrong, and that's when we get to learn a lesson. So, what was a deal that went a little bit sideways for you? And then what was the lesson you pulled from it?
Um, well, I mean, I already talked about the biggest one, and which was subprime mortgage collapse and not buying for cash flow and over leveraging and not buying in recession resilient markets. And then I talked about the second one, which was the challenges associated with commercial real estate that losing a lot of value through that time. Um, those are probably the two biggest, challenges that I've had, and why I'm in a lot of industries that are non-correlated to real estate. Because the biggest lesson was learning how to invest in other markets that aren't driven by the same market fundamentals.
Awesome. So the lesson that you pulled from that experience was diversification, was putting your eggs in multiple baskets so that if one basket fell, you still got the two over here.
Right.
Awesome. All right, that leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
Yeah, so passiveinvestingmastery.com is our website. Passiveinvestingmastery.com. We do offer investments in commercial debt and commercial equity, and we have litigation finance, a legal fund, and medical receivables, which help to provide a well-balanced, non-correlated portfolio that was an aggregate gives you quite pretty strong, resilient portfolio. But also, we have an alternative investing mastery series, which you can register for there just on our homepage, which every week or two, I host completely different set of panelists on completely different asset classes. And I'd love to have you on, Gabe, sometime, because it sounds like you're doing some pretty cool stuff. But we've done everything from Forex to gold mining to timberland to we just did one on cannabis, which was, very interesting. And we've done every kind of real estate imaginable, as well as bourbon barrel cask investing and pilot education and buying a plane for cash flow and laundromats. So it's about everything you can think of. But when I was an engineer, I knew about the 50 stocks I could invest in, crypto and startups. I had no idea that there were 50 plus non-correlated alternative investment strategies that are far more resilient, higher risk adjusted returns, and build true stability and security in a portfolio. And I'm out there trying to share those agnostically with everyone and getting panels of people together to talk about them. And so that's what our alternative investing mastery series is. And I recommend everybody register, but set up a meeting with me. I mean, I love to chat with people. If we're not the right stop for you, we've got a Rolodex of a bunch of different sponsors doing all kinds of different stuff, and we can get you pointed in the right direction.
Awesome. I will put that link in the show notes. So if you guys want to reach out to Patrick, all you got to do is click the little more in the description. It'll pull down that full description, and in there you can find Patrick's links. All right, man. That wraps it up. Thank you very much for hopping on the show.
Yeah, glad to be here, Gabe. Thanks for having me.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. If you guys want to support the show, just leave us a comment, review, anything like that. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.